All right, let's start by taking a deep breath here. Stocks are down, crypto is crashing in real time, and a number of lending platforms at risk of going insolvent, meaning they will not be able to pay their debt, is growing. One of the rare few things that hits harder than this is my man All Might. Shout out to any of my Hero Academia fans out there. As of Saturday morning, Bitcoin and Ethereum have officially broken some key support levels and fallen below $18K and $900 respectively before bouncing back a bit. These are levels we haven't seen since December of 2020, and while back then we were all excited about these levels because we were trending up, this go around we're trending down and at an alarming rate at that. When you see headlines like this one here, it begs the question, is Bitcoin and crypto dying? The last time I talked about crypto on the channel, I shared with you data on how Bitcoin could make its way all the way up to $1 million per coin, which sounds crazy if you haven't seen the data, so go and watch that video too. But with the worsening market conditions, the countdown to July 30th when we find out whether or not we are entering into an official recession, even 100K Bitcoin that some were touting feels way far out of reach, right? That said, there are signs to those paying attention that this isn't the end. And that's what I want to talk about and explore in today's video. Hello everyone, welcome back to Invest with T-Claus. My name is Tavi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. Quick reminder that this isn't to be taken as financial advice. I'm not a financial advisor. This is my personal approach to investing and the thought process behind it. That said, I do recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. Okay, so before we get into why it isn't all doom and gloom, let's start with how we got here. If you recall, last week Friday, we got the May CPI number. CPI is a backward-looking indicator and always lags a month behind. So the May number published Friday came in at a 40-year high of 8.6%. The reason this was such a surprise is because we had seen the decline in the CPI number from March to April. We went from 8.5% down to 8.3%. Consensus before Friday was that inflation had peaked, right? I thought that too, and we would start trending down. Clearly, that was not the case, and that was strike number one. Strike number two came in the form of data from the University of Michigan Sentiment Survey showing that the public is losing faith in the Fed's ability to get inflation back under control. Basically, if people don't believe that the Fed can address inflation, consumers could drastically reduce their spending because inflation leads to recession. The problem is, the Fed has to raise interest rates to combat inflation. However, if consumers stop spending and the economy slows, then raising interest rates into a slowing economy increases the chances of a recession. It essentially becomes a self-fulfilling prophecy. Anyways, the Fed slapped a 0.75 percentage point increase on a Fed funds rate, even though they had previously said that only a 50 percentage point would happen in June. Market initially cheered because it meant the Fed means business and was dedicated to getting the inflation genie back in the bottle. But then, this is the ironic part, market and crypto sold off sharply afterwards the very next day, plunging the SP 500 formally into bear market territory and destroying the last big psychological support level for Bitcoin, Ethereum, and crypto broadly speaking. So again, that was strike two. Strike three is what really spooked markets, essentially erasing most of the hope and indicating that there is more pain ahead, and our self-fulfilling prophecy into recession is even more likely to now play out. That data point was the release of the new mortgage rates with the biggest increase since 1987. So there you have it. Now you're all caught up and you know why we're here. But don't worry, everything is fine, right? So now let's talk about why this current drawdown is, in my opinion, an opportunity to set yourself up for the next bull run. Let me play you this clip to tee it up.
Bitcoin prices are getting whacked today as the equity market sell-off hits crypto. This weekend alone saw $150 billion wiped off the value of the crypto market. Mark, are we seeing, just given the route in crypto, the total market cap, let's just make it simple for folks out there, are we seeing a complete loss of confidence in crypto as a future investment vehicle?
No. I think the short answer to that is no. You've got too much institutional adoption. You have too much institutional money in the space. What we have happening now, and I say this a lot, guys, this is still a nascent industry. It's still early. It's still a risk asset, including Bitcoin. And in any nascent emerging asset, you go through a maturation process. And that maturation process includes flushing out, and it's painful when it happens, but it includes flushing out the weaker market participants, whether we're talking protocols, whether we're talking exchanges, whether we're talking staking platforms. This is, and I know it's hard for me to say this because it's painful now as it is for a lot of other crypto investors, this is a necessary part of the process for this asset class to evolve, but it is not going away.
First and foremost, not a shred of hesitation in his answer. And when you think about it, to his point, the total crypto market cap in the grand scheme of things is currently pretty insignificant compared to the rest of the other asset classes. I mean, look at where gold is versus Bitcoin, for example. That said, the sector has now reached an inflection point where everyone who's paying attention again understands that crypto and blockchain technology has way too many benefits to not be fully integrated into everything we do. And that means that businesses and protocols that survive this crypto winter will emerge even stronger. You can see this from the military leveraging crypto to improve traceability and accuracy in their supply chain. This is a great use case example proven in the last cycle and has been 4 years in the making. Moving on, a recent survey by Deloitte, one of the big four global consulting firms, supports this view as well. With crypto and blockchain networks, transaction takes seconds or a few minutes at most, versus 3 to 7 settlement days with the current financial system. And so it's no surprise that they found that 85% of merchants expect ubiquitous digital currency payments in 5 years. But for that to be as widespread as expected, you need price volatility to diminish and or use stable coins as an intermediary to mitigate that price volatility. That's why stable coins pegged to a strong currency like the dollar or euro are needed. And whether you realize it or not, stable coins are what underpins DeFi. Yes, we had the Terra Luna debacle. However, every stable coin that is actually backed one-to-one, or at least with ample fiat liquidity, continues to weather this storm without any issues. And it's for that reason that Circle, the company behind USDC, is now launching the equivalent euro coin, or UROC, to be pegged to the euro. And I can also point out to you that with American Express launching its first crypto reward credit card that gives you back Bitcoin and Ethereum to start, this rounds up the 3 biggest credit card networks in the world, so Visa, MasterCard, and American Express, incorporating a crypto strategy. They wouldn't pursue this if adoption and demand wasn't clearly growing rapidly. Now, I'm not going to sit here and tell you that investor confidence has not been shaken up. However, it's bills like the one presented by Senator Loomis and Gillibrand that will provide clarity and establish a regulatory framework that protects the masses and helps bring people back who get burnt. Ultimately, that will continue to grow the adoption exponentially. Regulating stablecoins is where things will start, in my opinion. By the way, this is a bipartisan bill in the US, and it will likely usher in the very first Bitcoin spot ETF. That in itself will be a huge, and I mean massive, catalyst for the Bitcoin price recovery. All that is great, but maybe one of the biggest vote of confidence out there right now, and one that I've been paying attention to, comes from the sentiment and how the largest asset managers are positioning themselves when it comes to Bitcoin, Ethereum, and the top cryptos. BlackRock is the world's largest asset manager with 10 trillions, not billions, $10 trillion of asset under management. For context, that's as much as the total global market cap of gold in 2021. Okay? All right. Now, in an interview this week, Rick Ritter, BlackRock's chief investment officer, had this to say, and I quote, "Bitcoin and crypto are durable assets. I think there's a healthy recalibration going on. If you look 2 to 3 years hence, they will be higher than today." And he continues with, "When you keep policy too easy, the leverage builds in the system, and you're seeing a lot of the leverage that was built up around crypto come unglued pretty darn quickly." End of quote. I'll link the interview if you want to go and read it for yourself. But the point is, he owns Bitcoin personally, BlackRock has exposure to Bitcoin, and Rick previously stated, and I quote, "Cryptocurrency is here to stay. Bitcoin could replace gold, and Bitcoin is so much more functional than passing a bar of gold around." End of quote. What I want you to realize and understand is that until the space is sufficiently regulated on a global level, the amount of institutional capital and sovereign wealth needed to drive Bitcoin to 100K and possibly 1 million someday, maybe as early as the end of this decade, will not flow in. But again, that regulation is coming, right? And faster than you think over the next couple of years. It's unclear whether or not the SEC will approve grayscale spot Bitcoin ETF application here in July. But again, if they do, that would be a pretty significant catalyst that would help not only stabilize Bitcoin, but also reverse the negative trend upward, right? And that's what we want. There is a reason the majority of high net worth individuals like Ray Dalio, Kevin O'Leary, Rick Ritter, Elon Musk, and many others out there are embracing Bitcoin and digital assets, and consequently, why wealth management firms have been advised to prioritize providing education and advice, as this survey found. There's a reason McKinsey, another one of the big four global consulting firms alongside Deloitte, is letting you know that the metaverse could be worth $5 trillion by 2030. There is a reason Fidelity Investment and Retirement Plan Provider is now offering employees and clients alike the ability to invest up to 20% of their retirement capital into Bitcoin. And the list goes on and on and on. The bottom line is this. As painful as this drawdown feels in the near term, you have to zoom out and truly shift your mindset in order to realize how big of a buying opportunity this actually is. You can see in the table here, Bitcoin's yearly return since inception. No one, and I mean no one, who stayed invested in Bitcoin 3 years or more has ever lost money. And this was before we hit this inflection point. Also, all things metaverse, so think NFTs, DeFi, are primarily built on Ethereum, and Polygon is by far the biggest scaling solution for Ethereum. Combined, they have the most network adoption. This isn't to say that other protocols aren't great, but if the metaverse could be as big as $5 trillion by 2030, this implies over double the growth of the current crypto market by then. And who do you think stands to benefit the most? Would you rather buy in and establish your positions at these lower levels, or wait till it's safer and more stable to jump in and pay that hefty premium, assuming you don't actually get completely priced out? Personally, I know my answer. Now, this doesn't mean that you should ape in and go full degen, right? But rather size your position appropriately by dollar cost averaging in. There's absolutely more pain ahead, I'm not gonna lie to you about that, in the coming weeks and months, but I can also say with certainty that we are closer to the bottom than we are to the top. And the upside potential over the next few years isn't something I'm willing to miss out on again personally. For that reason, I've been buying a little bit of Bitcoin at a time, with every $1,000 drop in the price of Bitcoin since around 22,000 as an example. And I intend to continue until I reach my goal. Now, here's the last thing I will leave you with. When we're in bull markets, right, everyone wishes they had gotten in on the ground floor during the last crypto winter, and they cry over how much gains they could have made. I say this all the time, right? Fortunes are built in bear markets and crypto winter. If you missed a parabolic climb in 2020, this is your chance to potentially make up for that. What you do with that chance is up to you. And on that note, I'll leave it here for today. By the way, I know it's Father's Day. I actually did get this really cool shirt for my wife. Pretty excited about it. Happy Father's Day to all the dads out there. For everyone else, including the dads, don't forget to drop this video a like if it helped you gain a new perspective, and share with others who you think could also benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you too can stay in the know. As a reminder, I post every Sunday. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.